Swayam Prabha. Digital India. Educated India.
Good morning. In session 14, we will be discussing about the development of Indian foreign exchange market, and already we have discussed different phases of foreign exchange market, how foreign exchange market all over the world developed, how the currency standard established, how the economy or the world economy migrated from barter system to a what is called a metallic system, then migrated to inconvertible paper currency standard. We have discussed about the inconvertible paper currency standard, the conversion rate, and thus required a establishment of foreign exchange market. Foreign exchange market is very important, particularly for international trades. When international trade take place in different currency standard, and that currency standard themselves in convertible paper currency, it requires the development of foreign exchange market. Foreign exchange market particularly develop in developed country and the newly established colonial country, particularly when they got their independence, they established their own economic format, and in this process they developed different phases of the foreign exchange market. When you consider about India, India got its independence in 1947. After that, as a part of the colonial regime, it was part of the Great Britain pounds, and Great Britain pound, that is the pound sterling, continue to be one of the major currency for India, and over the period Indian financial market developed, the foreign exchange market developed, and we have migrated from the what is called the pound sterling regime to a US dollar regime, and also we have established what is called the different parts of the foreign exchange market, particularly the foreign exchange spot, foreign exchange forward, foreign exchange future, options. These are the requirement for a efficient foreign exchange market. And in this session, we will be discussing about the development of Indian foreign exchange market over the years. We will be discussing about the policy regimes, we will be discussing about the policy framework which leads to establishment of a what is called a more efficient foreign exchange market in the Indian context. In this session, we will be discussing about the different committee reports and how the committee reports have been implemented over the years to establish the Indian foreign exchange market. Let us start with the India. If you see, the India had followed a strict exchange control from the time of Second World War. The Second World War, starting from early of Second World War, particularly 1940s onwards, India followed a strict exchange rate regime. The regime requires that without the permission of the government, you cannot convert the currency into either gold that time or the paper currency standard, and the strict exchange regime was implemented, was adopted only to preserve the current currency. After the Second World War, when India got independence, the Reserve Bank of India, that is India Central Bank, took over the management of foreign currency, and RBI RBI particularly looked at the conserving foreign currency which was precious that time. The foreign currency resources were preserved and the foreign currency was used particularly for the development of the current country for the import requirements. The import requirements here, at the first 5-year plan during this 1952 to 57, 58 that time, we required capital intensive industry and this import requirement was fulfilled for preserving the foreign currency. The exporter had to surrender the foreign currency to the authorized dealers. Authorized dealers primarily were banks, commercial banks, and the authorized dealer provided the rupee are decided by the currency exchange rate by the RBI. The purchase and sale of foreign exchange or foreign security by Indians were strictly controlled. As an Indian, you cannot purchase foreign currency assets, you cannot transfer the foreign currency from India to other country without the permission of Reserve Bank of India. And the conversion or the requirement of foreign currency were decided by the RBI for which purpose we need the foreign currency, what will be the rate decided by the RBI. In 1978, the RBI allowed banks to undertake intraday trading in foreign exchange, and this perhaps marked the development of or the beginning of the Indian foreign currency market. The 1978 RBI allowed banks for intraday trading. Intraday trading means within a day there will be minute level of fluctuation of exchange rate will be there. In this band of exchange rate fluctuation, the authorized dealer can buy and sell foreign currency, and this step lead to the development of or beginning of the Indian foreign currency market. As an opportunity to make profit through arbitrage, major banks started quoting foreign currency in two-way pricing system. The two-way pricing, as we discussed earlier sessions, is a buying rate and selling rate, and buying rate, selling rate provide the difference of buying and selling rate provide some kind of transaction profit, and transaction profit whenever there is a cross currency requires spot, it provides some kind of arbitrage opportunity, arbitrage profit for banks, and banks since 1978 they started quoting foreign currency for intraday trading purpose. During 1975 or 78 to 91-92, the exchange rate regime India characterized by what is called daily announcement of exchange rate by the RBI for buying rate and selling rate, and at that buying rate and selling rate authorized dealer provide exchange rate buying and selling quote to the merchant, and merchant transaction or the export import transaction depends upon the what rate the RBI announcing the exchange rate and what transaction profit or transaction exchange or transaction what is called transaction fee the banks are charging. So, 1978 till 1992 it was the daily announcement of foreign exchange rate by the RBI. On that rate banks or authorized dealer provide different kind of exchange rate or quote to merchant export import for other transaction purpose, and this was a strict regime followed by RBI for the preservation of foreign currency. However, the exchange rate market was not developed, exchange rate market itself was not there. A authorized dealer among themselves create a spot exchange rate, and the spot exchange rate governed by the RBI daily announcement of exchange rate for different currency. If you see in a pragmatic way, there was no exchange rate market till 1992 in India. The foreign exchange market developed after 1992 when the liberalization measures were initiated by the RBI. In 1992, our Rangarajan committee, they provided the exchange rate system or the foreign exchange development in Indian context. The foreign exchange market development process was initiated by the Rangarajan committee report. Rangarajan committee had given a phase manner how to develop the foreign exchange market in Indian context. They started with a what is called a liberalized exchange rate management system, which primarily provide a dual exchange rate for export, for import, and for the conversion of foreign exchange into different currency. This continue, the dual exchange rate system continued till 1992, which was ultimately lead to convergence of the dual rate to a unified rate or a market determined exchange rate regime. The dual exchange rate primarily for exporter importer. On the dual exchange rate, when the exporter surrender their foreign currency, they will get a part of the foreign currency at the prevailing market rate, that is independent for them to convert into a prevailing market rate. A part will be converted into a what is called a rate decided by the RBI. There was a dual exchange rate in this process. A dual exchange rate creates some kind of uncertainty, some kind of arbitrage opportunity, and this dual exchange rate actually was a stepping stone for the conversion of Indian rupee to a market determined exchange rate regime. And market determined exchange rate regime was initiated in 1992, March 1992 onwards. On the market determined exchange rate, the current account of the balance of payment was liberalized, and the current account at present, all items of the current account, primarily the export, import, inward and outward remittances, the family living expenses, for the all other day to day transaction of exchange rate except the capital mobility was forced to convert at the market rate. So, there was no requirement on the part of the exporter importer look at the any RBI rates. RBI stopped announcing the daily rates, and the rates were market determined, and authorized dealers were given the permission to quote exchange rate as per their own demand and supply. At present, we have current account convertibility, and a significant part of the current capital account has been liberalized. And if you see the exchange rate at present, there are many authorized dealer, each dealer quoting different rate. And why different rates are there? Because each dealer on the basis of their demand and supply, on the basis of their requirement, they quote exchange rate. An exchange rate of different currency, particularly rupee against pound sterling, rupee against euro, rupee against yen, rupee against US dollar, Canadian dollar, Australian dollar are now market determined rate. This rate particularly market determined in the sense that there is no requirement on the part of the authorized dealer to look at the rate provided by RBI, and at present also RBI not defending any particular rate, and RBI not declaring any daily market rate for any kind of exchange, any kind of foreign currency. The process of current account convertibility allowed Indian banks, Indian foreign exchange market or the central bank to sign the agreement with the IMA, what is called the Article 8 of an International Monetary Fund. The Article 8 or Article VIII, by accepting this article, India declared that the current account convertibility of the Indian rupee. The Indian rupee, the INR 100% convertibility on current account transaction. As I mentioned earlier, current account transaction is a significant part of foreign currency movements. Current account indicates the export, import or international transaction of international trade side and invisible foreign currency foreign exchange rate, particularly the invisible items, what is called services payment, interest rate payment, what day to day family living expenses, travel, tourism, all are the current account convertibility. The current account indicate what is called the day to day transaction of foreign currency, and this day to day transaction of the foreign currency are present by accepting the article 8 of the IMF. India now it is market determined in case of India. Among a few country India at present, among one of the few country India at present is market determined exchange rate for current account, and this indicate a significant step in the development of Indian foreign currency market. After accepting the Rangarajan report and converting the Indian rupee, particularly for current account convertibility, Indian government or the RBI tried to adopt different phases of foreign exchange market. The different phases here, the spot market development, the forward market development, the future market development of foreign currency. When the exchange rate is market determined, it creates risks, because the fluctuation of currency, it is a risk for the international transaction process, and realizing this, the RBI wanted to establish the foreign exchange forward market to prevent this kind of fluctuation of foreign currency and provide some kind of hedging product, risk management product for the exporter and importer. In this process, RBI established a committee, what is called Sudhani committee, to provide a path for the further liberalization of foreign currency market in India and for the establishment of hedging market or foreign currency forward market in case of India. The freedom here Sudhani committee provided some kind of interesting report to Government of India and RBI, and they provided what is called a path, a clear cut path for the establishment of the foreign currency market in India. In this process, the Sudhani committee recommended that freedom to initiate trading position in the overseas market. So, what does it mean? It provides they advocated that Indian authorized dealers should be allowed for trading in foreign currency market in overseas market, particularly international market. They also mentioned that freedom to borrow or invest fund in the overseas market. Bank and corporate should be allowed to invest, allowed to borrow or invest in foreign currency in abroad market. Freedom to determine the interest rate on foreign currency non-resident deposit, what is called FCNR deposits. Bank accept foreign currency deposit, then this foreign currency deposits interest rate earlier it was determined by the RBI, and Sudhani committee advocated that this interest rate on foreign currency deposit, that is called FCNR deposit, should be deregulated and let the authorized dealer or the bank decide the interest rate on foreign currency deposit. And similarly, freedom to use derivative product for asset liability management. Banks should be allowed to use derivative product for asset liability management. Bank accept deposit for short run and short deposit, that is 1 or 2 year, 3 year deposit, but create loan for longer period, more than 5 years, 7 years loans create. In this process, there is asset and liability mismatches. Thus, mismatches can be addressed. If its mismatches are in the form of foreign currency, this can be addressed through derivative transaction. And In this process, the Sodhani committee recommended for the establishment of derivative market or the forward foreign currency forward market, future market for in case of India, and banks should be allowed to use the derivative product for the asset liability management side. Corporate also have given the freedom to hedge anticipated exposures. Corporate, those are big corporate having presence all over the world, having transaction in export import related items, generally they face what is called problems of foreign currency fluctuation. In this process create uncertainty in their balance sheet, in their transaction process, and Sodhani committee recommended that for a corporate having a underlying exposure in foreign currency should be allowed in using the derivative for the risk management purposes. Banks can offer cross currency options to back basis to corporate. Banks should be allowed to provide cross currency exchange, foreign cross currency options for the to corporate for risk management purpose. And in this case the Sodhani committee recommended that cross currency option, that is options having if a underlying risks in dollar, you can go for buying a options product in yen, and this process you can minimize your exchange, minimize your risks, and banks should be allowed to offer cross currency options to bank corporate having underlying exposure. The banks Sodhani committee also recommended that RBI should develop a policy framework for framing what is a comprehensive risk management guideline for banks. Banks having significant transaction in foreign currency, and there should be proper risk management practices guideline for banks, and Sodhani committee recommended that RBI should provide what is called a comprehensive guideline for risk management for the banking sector. Bank also Sodhani committee recommended that RBI should create a policy framework for the implementation of Basel committee norms on computing foreign exchange position limit and recommending a special capital backing for open position. What does it mean? It means that the Basel committee which frame the guideline for risk management practices for banks, and the guideline provided, the Basel committee provided the guideline for particularly the foreign exchange position, open position of foreign currency, the capital position of the foreign currency, and in this process Sodhani committee recommended that RBI should adopt this Basel committee recommendation and allow the bank to go for a risk management practices as per the norms of the Basel committee for their open position, and also for their position for the what is called requirement of capital to absorb the open position. Whenever there is open position, there will be risks in fluctuation of exchange rate and for this to absorb this risk, banks should have significant amount of capital. And as per the Basel committee recommendation, the Sodhani committee recommended that RBI should adopt the Basel committee recommendation and provide the open position risk management capital backing system for the banks in India. So, Sodhani committee primarily recommended a clear cut path for the development of Indian foreign currency derivative market, and particularly for preventing or absorbing the risks in fluctuation of foreign currency. And in this process they recommended the RBI to prepare comprehensive guideline for risk management practices of bank in India, particularly in the area of foreign currency market. If you see, there are another committee particularly after the 96-97 it was established by the RBI, which is called as Kharagpur committee. The deputy governor of RBI headed the committee, and they recommended what is called a capital account convertibility capital account convertibility, comprehensive guideline for the foreign exchange market development, and also they recommended for the corporate sector joint venture, then also recommended what is called FI limit for different FI, that is foreign institutional investment in India, foreign direct investment in India, and also recommended what is called the mutual fund for foreign currency transaction side. That is particularly in the area of opening up Indian capital account. The capital account particularly deals with, as you know, in case earlier we discussed about the capital account convertibility side. Capital account primarily foreign exchange, large scale foreign exchange transaction involved. It involves the foreign exchange security aspect, foreign currency securities or investment aspect. Here the FI, FDI, joint venture, foreign limit in what is called limits for foreign investment in India. These are the part of the capital account convertibility side, and the Tarapur committee was established for the giving recommendation for capital account convertibility side, and the Kharagpur committee took into account the policy framework for developing the FI investment, FDI investment, mutual fund investment, the joint venture side, and also some guidelines they provided for the reframing the SEBI Act. If you see the capital account Tarapur committee recommendation, the Tarapur committee recommendation are comprehensive in the sense that it provides a clear guideline for the opening of the capital account in case of India. The foreign direct investment, foreign portfolio investment, investment in joint venture, wholly owned subsidiary, abroad project export, opening of Indian corporate offices, all are the part of the recommendation of the Tarapur committee for Tarapur committee. The Tarapur committee mentioned that foreign direct investment should be liberalized, different sector of the economy, particular different industrial segments of the economy where the foreign direct investment requirements are there, this should be diluted, and there should be the cap in foreign exchange foreign direct investment should be reduced, and foreign direct investment should be allowed in different sector of the economy other than the sensitive defense or security sensitive defense sector. And here also they mentioned that the Kharagpur committee mentioned that corporate houses should be allowed to open office in abroad, corporate houses should be allowed to borrow money from abroad in foreign currency, corporate house with corporate debt management practices should be developed, corporate should be allowed to raise foreign currency from the abroad market in the form of ADR, JDR issue, in the form of foreign currency borrowing, and at the same time they also mentioned that FI investment in different sector of the economy should be looked into further. There should be liberalization of FI investment in Indian stock market, and FI limit for different sector different segments of economy should be reduced, so that FI can invest further in Indian foreign currency market, and in this process we can develop our foreign currency reserve. The portfolio investment in case of FI should be looked into in such a way that the defense sector, particular defense segment, national security regions are there, national importance, those sectors are very important for security, should be debarred from the FI investment, and other sector should be open up for FI investment. And also they recommended that Indian corporate houses, those who have good corporate rating, those who have good company rating, they should be allowed to raise foreign currency from abroad. They should be allowed to open their offices in abroad, so that the subsidiary, wholly owned subsidiary in abroad can be a part of the domestic investment sector. The committee on the Tarapur committee, as a part of improving the risk management practices, recommended for the introduction of interest rate swap and FRA, the forward rate agreement. These are the risk management product, particularly in the foreign exchange market. And they also recommended registering Indian mutual each mutual funds manager including the mutual fund to invest in overseas market subject to SEBI guideline. So, Indian fund manager including the mutual fund should be allowed to invest in overseas market as per the SEBI guideline. So, what the Kharagpur committee primarily address the capital account convertibility side. The capital account convertibility side capital account convertibility primarily having a different aspect of foreign currency inflow and outflow. This inflow outflows are large in the sense that involves FDI, foreign direct investment, foreign institutional investment, portfolio investment, joint venture etc. And the Kharagpur committee wanted to increase our foreign currency reserve. So, significant reserve provide us some kind of stability in foreign currency market. It will enhance the sovereign rating for India, and for this they recommended a significant liberalization on the part of the RBI, on the part of Government of India to increase the FI inflow, FDI inflow Indian domestic market. And in this process they also recommended that Indian domestic players, particularly the big corporate houses having good rating, they should also be allowed to open their overseas office. They should also be allowed to borrow from foreign currency market, and in this process they can get cheap foreign currency fund which lead to further investment in India. In this process the Kharagpur committee recommended for the significant liberalization of Indian capital account convertibility side, and this process has been adopted over the year. If you see Indian foreign exchange market at present, the capital account has been significantly liberalized, and over the year the RBI, the Government of India allow the FI to invest in India, both in equity market and debt market. Even FIs are allowed to invest in Indian GSEC market, that is the government security market, the corporate debt market, and portfolio investment, particularly the FI investment has been liberalized significantly. FDI sector also, foreign direct investment side, Indian government has liberalized many sector for the FI FDI investment, except the defense sector. All other sectors has been liberalized significantly. The manufacturing sector, financial services sector, the FDIs are allowed, and also in mining sector, mining quarrying side, FIs are allowed now. FDI also, FDI in case of retail sector, in case of foreign direct investment, in case of large scale investment, FDIs are allowed in different segments of the Indian industrial sector. And in this process at present Indian capital account has been significantly liberalized. Kharagpur committee also recommended a significant measure, particularly how to develop the foreign currency reserve system. Here also they mentioned that there should be proper foreign exchange management system. The foreign currency reserves, which are the reserves in the form of FDI, FIs are coming to India, how to manage this reserve. The reserve management aspect or optimum foreign currency reserve are the Kharagpur committee also recommended a significant policy side for the establishing what is called optimum foreign currency reserve in case of India. Recent liberalization, if you go through our recent liberalization, we have significant recent liberalization. Recent, particularly after the 2006 onwards, the Indian foreign exchange market liberalized significantly. Inflow outflow by non-resident Indian has been partially deregulated. Non-resident Indian, those who are NRI, their inflow outflow have been partially deregulated. They can inflow side there is no regulation, outflow side also significant liberalization has been done. The portfolio investment in India is allowed through foreign institutional investor. Portfolio investment, particularly investment in Indian stock market, Indian debt market, Indian mutual fund market, are allowed through the registered foreign institutional investor. The foreign institutional investors are registered as per the SEBI guideline. Through them, anybody in abroad can invest in Indian stock market, Indian debt market, Indian mutual fund market. The registered FIs are there as per the SEBI guideline, they register in India, and through them the foreign portfolio, the portfolio investment are being done. Then equity side, in the foreign exchange institutional investor can be invest in company under portfolio investment route. The FI can also invest in Indian company through portfolio investment. The portfolio investment, they can directly invest in Indian stock market, purchase company shares, and also they can directly invest in Indian bond market, purchase company debt instrument, and that is through the portfolio investment side. And then also Government of India and the RBI established what is called Foreign Investment Promotion Board, what is called FIPB. FIPB, through FIPB considers all kind of foreign direct for FDI investment and setting the limit for different sector of the economy. They also are responsible for the liberalizing the FDI investment in case of India. In this process, they also liberalize different sector of the economy. Many sector of the economy, many industrial segments has been 100% FDI investments are there, except the foreign Indian defense sector, many other sector, the FDI investment have been liberalized more than 75%. If you see the FIPB investment side, oil refining sector, business to business, e-commerce and internet service provider, these are 100% liberalization recently approved by the FIPB, that is Foreign Investment Promotion Board. FDI is permitted in the special economic zone. Government of India and the Ministry of Commerce has established different sector of the different segment of the economy in the form of special economic zone. There are many special economic zone in India. In this special economic zone, FDI 100% investments are there. Foreign direct investors can invest 100% in FI special economic zone. It is considered as a export processing zone. All whatever the manufacture take place in export processing zone or the special economic zone, there 100% FDI investments will be there. All goods and services will be exported from there, and domestic sales of goods and services produced by the special economic zone are not allowed. FDI investment in the special economic zones are 100%. FI in foreign equity participation up to 26% has been allowed in insurance sector, up to 75% allowed in banking sector, and also many other sector, particularly the financial services sector, the FDIs are allowed significantly. If you see the foreign institutional investment and foreign direct investment, they are going at par, because first they are allowing FI investment, after that they are allowing liberalizing the foreign direct investment. In this process, the foreign ownerships are changing. In case of direct investment, the owner are the FDI, because they participate with the domestic company and FDI investment take place. In case of FI investment, no doubt the investment is taking place in equity market or debt market. However, there also ownership patterns are changing, but FDI is more stable in nature, FIs are more volatile in nature. So, FDI brings policy, brings technology, brings service, brings experience. However, FI there is only portfolio investment which is highly volatile, and over the year Government of India providing more experience, more learning through the process of liberalization of foreign exchange market, and experiencing the volatility in the stock market, try to address this issue through the FI investment. However, FI investments are more volatile in nature. It is very important for us to have more FDI indirectly in our economy rather than giving more importance to FI investment side. However, together we are liberalizing both FI sector and FDI sector, together we are liberalizing and we are giving more importance to FDI side and also at the same time FI side also. However, FDI required some kind of basic requirement, some kind of infrastructure facility. After that only FDI investment can come to India. FI investment requires the liberalization of Indian financial sector, that is the policy framework on the part of the RBI and the part of the government of India. However, if you see the recent policy changes, the recent policy changes primarily focus on more foreign currency inflow to India and also giving importance to FDI side rather than FI side. At this juncture, government of India has allowed, the RBI has allowed the Indian domestic company, particularly those who have good corporate rating, those who have established company to go abroad and dilute their equity indirectly, what is called through JDR approach, global depository receipt and American depository receipt, and this some extent provide equity dilution side of domestic company in international market. We will be discussing in detail about the depository side. However, depository side provides significant revenue, significant capital inflow, foreign currency inflow to Indian foreign exchange market. The good company in India, those who are good corporate rating, having significant amount of profit, good profitability parameter, they have diluted their equity through JDR or ADR routes and mobilized significant part of the foreign currency. And this also another way other than going through the ECB route, what is called external commercial borrowing routes, external commercial borrowing in the form of debt instrument which need to be repayment for after the maturity period, and also in between there should be interest outflow will be there. Our external commercial borrowing depends upon the rating of the particular Indian company. However, JDR ADR that is a global depository receipt or the American depository receipt is a debt instrument through equity. The underlying asset is equity, and through the equity this company are getting foreign currency from abroad by issuing equity debt related equity investment. Debt related equity investment in the sense that the equity underlying assets equity converted into debt, and the debt are being listed in NASDAQ, listed in New York Stock Exchange market, and this process they get the purchaser of this in JDR ADR, they are getting what is called dividend in the dividend, not the interest rate. The dividend or interest rate may not be constant. Here also there is no repayment on the part of the, as per the ECB side, there is repayment of principals are there. In JDR ADR side there is no repayment because underlying asset is equity. In the events of the abroad investor wants the repayment, they have to sell the JDR ADR in Indian domestic market and converted the equity at the prevailing price and get the principal outflow. And this process JDR ADR provide some kind of avenue on the part of the domestic company to list their share in abroad market and get good amount of valuation for their company. And in the recent policy change, one part of the JDR ADR, another part is the FDI investment in different sector of the economy, another part is what is called dilution of equity, particularly for an institutional investment, for a direct investment in the financial services side, and also the economic zone investment, special economic zone where FDI investment can be 100%. Then another part is the oil refining sector, business to business, e-government sector, internet service provider. These are the foreign direct investment 100% are allowed. Foreign institutional investment routed to particularly portfolio investment should be routed through the what is called the listing of the what is called registering of the FI in with the SEBI, and through them that will portfolio investment will take place in India. This provides some kind of guideline for the for enhancing the Indian FI investment side and FDI side. However, the recent policy changes, there are significant policy changes in the form of what is called debt market development, that is called infrastructure side. Also the foreign direct investment can take place in India. Many segments of the infrastructure are being where the FDI limits has been enhanced, and foreign institutional foreign direct investment in infrastructure side are allowed through the FI, through FIPB what is called Foreign Investment Promotion Board. They are looking at the infrastructure side, and specific infrastructure they are allowing 100% FDI investment side. If you see the roadmap in case of India, the roadmaps are, if you see the how the foreign exchange market in India developed over the year, particularly after 78 1947 to 1978, the Government of India followed a strict exchange rate control regime. 78 authorized dealers or commercial bank allowed for intraday transaction side. After this continue up to 1991. After 91, we have liberalized our foreign currency market through the financial sector development policy, and in 91 Government of India follow what is called a dual exchange rate system. Dual exchange rate system, the exporter allowed to selectively allowed for converting the export processing, export proceed, particularly the export earning for 60% at the rate of RBI declared rate, and 40% allowed for market determined exchange rate. This dual exchange rate was essential for going towards, or the beginning for going towards what is called a market determined exchange rate regime. 92 March onwards, Government of India declared the current account convertibility side. Their current account convertibility side there should the current account export or imports are allowed to get the rate as per the market rate. Authorized dealer allowed to quote foreign exchange rate, and there are different rates for different authorized dealers. And in this process 91 further liberalization in the form of what is called a automatic routes, that is called FI FDI through automatic route. There is no need of any kind of permission on the part of the FDI or FI to come over India. 35 sectors were declared for automatic routes for 51% FDI or FDI investment, and this FDI investment further increased in 97 to 74%, and many 111 sectors were included in automatic route, and 100% foreign FDI investment allowed in this sector. Then up to 100% under automatic route to in all sector except small negative list. Their Government of India 2000 declared a negative list for defensive sector, for different national importance sector like nuclear power sector. There is no foreign exchange FDI investment in this sector. All other sector 100% FDI investments are allowed, and all other sectors are included in automatic route. All sectors except the national important defense sector, nuclear power sector, these are negative list, and all other sectors are allowed to invest automatic route of 100%. Then to post 2000 sectorial cap raised and condition relaxed. Sectorial cap for FI investment, sectorial cap for FI investment in equity market, sectorial cap for FI investment in debt market, mutual fund market, and it has been relaxed. The financial services sectors were deregulated, particularly financial sector for investment, for an FI investment, FDI investment in financial services sector also allowed. Financial service, particularly the insurance sector, banking sector, the FI investment is allowed. These are the policy framework over the year how the foreign exchange market had developed, and foreign exchange market development requirements are there. There should be clear guideline for FI, FDI inflow, foreign purchase of foreign security, foreign assets, foreign security and foreign asset requirements are there for the development of Indian foreign exchange market. The foreign exchange market also requirements are there, that stability in policy framework, and Government of India has adopted the policy framework for stability region. A stable policy requirements are there for the development of foreign exchange market, because as we have discussed earlier, foreign exchange market is highly volatile. Any kind of negative pulse is there in any segment of the foreign exchange market, it leads to outflow of foreign currency, and we have seen the Chilean crisis, we have seen the Mexico crisis, we have seen Asian foreign exchange currency crisis. So, foreign exchange market is stability requirements are there for policy framework side. If you see foreign direct investment over the year, you see how the foreign direct investment has increased over the year since 2005-6. I have given the data for 2005-6 to 2011-12. Over the year, there has been significant increase in foreign direct investment. This has come only because India adopted a stable foreign direct investment policy. In 2005-6, it was 5,419 million, which increased to 32,955 million US dollar over the year, last 7 years. And this justify the a positive framework in the policy side from the Government of India, from the RBI side on the foreign direct investment. And if you, this is the end of this session, particularly we have discussed here the development of Indian foreign exchange market, and further references are there. If you want to study more for the how the levelization took place in India in case of foreign direct investment, you can go through the different annual reports of RBI from 92 to 2011, and also you can go through the economic survey of Government of India 91 to 2011. In different economic survey, Government of India and the RBI outline the foreign exchange policy, and you can go through that, so that further references what is called information you can get from this report. And for the model question, I have framed 2 questions for you. You can discuss what is called discuss the liberalization of Indian foreign exchange market. As in this question, you have to discuss the development of Indian foreign exchange market, how the Indian foreign exchange market from the pound sterling to a US dollar market developed over the year, how from 1978 to 1992 we have Government of India or the RBI put forward what is called or practice what is called a strict exchange rate regime. The strict exchange rate regime was required because that time foreign currency inflow was very less for India. Indian exports were not significant to outweigh the imports, or imports were very high compared to our export. We required to preserve our foreign currency. For that reason, the Indian government and the RBI adopted a strict exchange rate regime. However, 91-92 we liberalized our exchange rate, and over the year we implemented different policy framework for the development of Indian foreign exchange market. The policy framework primarily addressed to the what is called convertibility of rupee on the current account side, on the capital account side. We have liberalized the current account significantly, particularly after 91-92 we liberalized the current capital account. Export or importers are allowed to get their required foreign currency from the market. Authorized dealers are allowed to trade in foreign currency, quote foreign currency. Then FDI, FI investments were liberalized significantly, and over the year capital account convertibility was significantly liberalized. Indians were allowed to keep foreign currency, allowed to trade in foreign currency, allowed to purchase foreign currency assets and liability. Indian companies are allowed to raise foreign currency from abroad in the form of external commercial borrowing, in the form of dilution of equity through ADR and JDR issue. How and also over the year how the SEBI had liberalized the policy for foreign investment, and foreign institutional investors are registered under SEBI. They are practicing foreign portfolio investment in India. FDI, different sector of the economy has been liberalized, and and you have to discuss all these in the liberalization of foreign currency market in India. Second question was on what would be the strategy for optimum foreign exchange forex reserve for India. So, what should be the strategy? This question was discussed in Kharagpur committee recommendation. Kharagpur committee recommended how much foreign currency reserve the RBI should have, because whenever you receive foreign currency, it was preserved with RBI, and RBI used this foreign currency for stability purpose. Any foreign currency, whether it is a dollar or pound sterling or yen or euro, is generally converted into what is called a domestic rupee. So, whenever there is a foreign currency inflows are there, it is converted into domestic rupee, and there will be domestic money circulation, that is the Indian rupee circulation increases in the Indian market. It creates what is called artificial inflation in the country. This hot money we call the foreign institutional investment, portfolio investment are hot money, because they are hot in the sense they are speculation, what is called speculation, because Indian debt market, Indian equity market is giving good return, they speculate the return and invest in India and get their profit, go out from India. This inflow outflow of FI create uncertainty or create volatility in the Indian stock market. At the same time, they also increase the rupee circulation in Indian economy. So, there will be inflation in Indian economy. So, when the RBI keep more foreign currency, though there will be artificial inflation in the economy, what is called the broad money supply in the economy increases. So, that should be optimum reserve we should have. The how to decide the optimum reserve, there is some guidelines are issued by the Kharagpur committee. The guideline is like with our foreign currency reserve should optimum in the sense that when it covers the 1 year 12-month requirements of our imports and other payments. Our foreign currency reserve is optimum in the sense that our requirements for payments of foreign currency for 1 year should be met. Another way we can have the foreign currency requirement is sufficient. So, sufficient in the sense that it should not create inflation in our economy. It should not artificially increase our interest rate in the economy, and also the foreign currency requirement is sufficient when you are in a position to our export, in a position to pay for our imports. And but there is no clear guideline what should be the criteria of foreign currency, optimum foreign currency reserve, because the foreign currency market, as I mentioned earlier, is a highly speculative market, highly volatile market, or what is called highly sensitive market. Any pulse, any kind of negative news in any segments of the market directly affect the foreign currency market. And we have seen overnight how the Mexico $40 billion outflow from the economy. We have seen the foreign Asian currency crisis, how a minor policy changes on the part of Thailand create a havoc in foreign Asian currency market. So, the foreign currency market or foreign currency optimum reserve is very difficult to decide, and it is on the part of the RBI should understand that the requirements of foreign currency in India, and RBI should follow a policy stability in the foreign currency market in Indian context. There we cannot say, you cannot say what should be the foreign currency optimum reserve in case of India. Only you can provide some kind of criteria for currency optimum reserve. There will be no scientific way to declare that the optimum reserve is 200 billion or 300 billion, because the reserve requirement changes overnight. Thank you. We will be discussing the